Hello and welcome to a discussion that will walk you through a simple example of how to prepare an indirect method cash flow statement. It is important that you view this before class so that we can learn how to prepare more complicated cash flow statements in class. After viewing this video, you will be able to prepare a simple indirect method cash flow statement. We will prepare an indirect cash flow statement for the company with this balance sheet. Take a moment to notice the different types of assets and liabilities the company has and the changes to each account. Changes in the current assets and current liabilities, noted in red, will be reported in the operating activities section. Property and equipment is a long-term asset, and cash changes will be reported in the investing section. Common stock and retained earnings are owner's equity accounts, and cash changes will be reported in the financing section. We will need some additional information to help us prepare the investing and financing sections. The first thing you should do is record journal entries for the additional information. This will help you determine the cash amount to report on the cash flow statement. There is not enough information given to finish the journal entry for the sale of equipment. We will complete this later in the video using T accounts. Net income will begin the indirect statement, and depreciation expense and the loss on sale are non-cash items. The cash amount of the purchase and sale of equipment will be reported in the investing activities section. The change in current assets and current liabilities is reported in the operating activities section. The change in long-term accounts will be used for the investing and financing sections. The operating section under the indirect method will look like this. Net income is adjusted for non-cash items and changes in current assets and current liabilities to get to cash from operations. Losses and expenses are added to net income because these amounts decrease net income and were not paid in cash. The company has more cash than net income. The increase in accounts receivable means cash from sales was not collected. Cash is less than sales included in net income and the amount is subtracted. The increase in inventory means more cash was paid for inventory than was expensed. The increase in accounts payable means cash has not yet been paid for, and the expense cash is more than income. The decrease in income tax payable means that more cash was paid than the tax expense included in net income, and cash is less than income. The next step is to determine the cash associated with non-current accounts. The best approach is to first make a T account for each and put the beginning and ending balances in each account. You should then record journal entries from the additional information provided. Put the amounts from the journal entries and any other information you were provided with the T accounts. Plug the amounts required to balance in each T account. Take a moment and note the amounts that are cash that will be reported on the cash flow statement. All plug amounts are assumed to be cash if no other information is given. You should notice that the $8,000 cost of equipment sold is not the cash amount. Look at the journal entry to find the cash amount of $2,000. The $2,000 cash amount is what is reported on the cash flow statement. You should also notice the plug to debit retained earnings is for the dividend paid. The operating section reconciles net income to cash by identifying the items that are included in net income that are not an exchange of cash. Non-cash expenses and losses are added back, and the change in current assets and current liabilities is the difference in what was included in net income and the cash that was exchanged during this period. The investing section shows the cash amount of purchases and sales of long-term assets. These two amounts are not netted. We computed these numbers by considering the changes to each non-current asset account. The financing section shows the cash amount related to changes in the owner's equity accounts. The change in common stock was an increase of $2,000. Common stock increases when stock is issued. No other information was given related to common stock, so we assume the change was in cash. The dividend paid was computed by examining the change to the retained earnings account. The total change in cash agrees with the difference in the beginning and ending balances of the cash account. After viewing this video, you should be able to prepare a simple indirect cash flow statement. Please fill in the blanks on the pages in your course pack and work through the self-test, the practices you learn, and the easy test on StudyMyAccounting.com to prepare for class. Thank you for being prepared for class. It is very much appreciated.